Welcome to the Treasury Update podcast, presented by Strategic Treasurer, your source for interesting Treasury news, analysis, and insights in your car, at the gym, or wherever you decide to tune in.
Welcome to the Treasury Update podcast. This is Craig Jeffery, your host today for an episode on Fed support for bank failures. I'm joined today by George Zinn. He's a former Microsoft treasurer, and he's the current president of Treasury Go. Welcome to the Treasury Update podcast, George.
Great to be here, Craig. Thanks.
So when we think about Fed support and bank failures, recent trauma in the financial sector brought down a $200 billion U.S. bank in very short order, with over $40 billion being wired out on a single Thursday. Other banks have either failed or been rescued by the Fed or by trillion-dollar banks redepositing billions to shore up those other banks. The pain is experienced well beyond the U.S. with the forced marriage with two systemically important Swiss banks following the SVB debacle. The Fed has promised to make depositors whole in these situations, so there hasn't been any loss of funds or long-term freezing of balances for individual or corporations. Does this represent an unlimited and permanent insurance coverage by the Fed? They showed up for these events. When won't they show up with coverage? George, I'm so glad to have you on today's podcast.
Great. I would like to just go over the arc of time to, I think, kind of quickly explain and not really rehash the news cycle of my perspective on SVB. The Greenspan put began in 87 with the crash, and veteran, traders were very surprised how quickly the markets came back in that situation. And, we've had various instances of what now become called the Fed put. One that people might have forgotten about is long-term capital management, where they were bailed out. That increase in liquidity led to, some say primarily drove the NASDAQ bubble, which was, again, a bust once credit conditions started to tighten. And so we've seen these cycles. We've also seen I think a particularly after the credit crisis, the change of attitudes of the U.S. Taxpayer in bailing out banks and the government acting as the insurer. When you insure something, there are data points that as properly insured person, I will drive my car faster. And that is simply a metaphor for taking greater risk. At this juncture, I think we have particularly an interesting data point was, as I understand it, the government, when they were determining over the weekend whether or not they would provide this backstop, particularly for deposits greater than $250,000, was a discussion that it can't cost the taxpayer anything. I think that was a very fundamental tenet of the Biden administration. This is a really, I think, honestly, a little bit of a shell game, because the FDIC, I've seen a number, let's call it 20 billion. So it'll cost the FDIC 20 billion. Round numbers. We're not debating it. It's got to be. And the reality is the way the FDIC stays solvent is they provide assessments to their member banks, effectively their insurance policy. And at the end of the day, we know that banks are not 501c3s, right? So where do you think that money's going to come from? It's going to be coming from the taxpayer's pocket in a reduced rate return on his savings account or her savings account, as well as potentially incremental fees that you can't keep track of. But I do believe that at the end of the day, the U.S. taxpayer is footing the bill. And the real question is, at what point, the discussion in the credit crisis was at what point is there a bank too big to fail? And you moved us to the Credit Suisse UBS situation. And it might be that in that situation, the one bank was systematically important, but it was possibly too big to save. So the forced marriage was basically wiping out the AT1 credit people as well as the equity. So it was not a full-on Fed put, let's call it.
Or central bank, yeah.
Yeah, exactly. And so I do think that, if we see the credit cycle continue to tighten, we see, quantitative tightening by the Powell administration, we are going to see sort of one of the results of this situation where we're going to have more distressed borrowers. Credit's going to be tighter. We end up in a situation where it may just be that the insurance is too expensive to bring to the table. And so for certain sectors like commercial real estate or private equity, which doesn't tend to have a huge, popular voting base, those types of places, if they can't raise capital and PE and VC firms have to raise, liquidity by selling equity, they're going to take some very probably steep discounts in their valuation, which obviously that nobody would want to do. I think that the one thing that I would say that is different from this good old fashioned bank run, as it's become called, is not just the moral hazard, but the digitization. How do you go bankrupt? Very slowly, then all at once. So there were some telltale signs that needed to be addressed before someone shouted fire in the theater and everybody ran for the doors. One of the signs was out of the Great Depression. One of the things that was created was the Federal Home Loan Bank. And basically what that bank does is they provide advances to banks. And in this scenario, they did just that for several months before even the crescendo. The challenge with the Federal Home Loan Bank advances is they charge somewhere between 4.5%, 5%. So it's not a sustainable way to necessarily run your business, I guess is the right way to say it. If you think about one of the challenges that various places, including Schwab, was experiencing these, crisis of confidence. And as you reached a certain point where the liabilities actually exceeded the assets and they really couldn't, sell what is supposedly the most liquid asset in the world, their treasuries, for various reasons. All of this kind of snowballed into what I think is one of the more significant and less talked about aspects of this good old fashioned bank run is, let's just call it digitization. So the rapidity of the people's ability to move money and move accounts is unmatched now. I think that is one of the less talked about aspects of this. I think it's, interesting. Means you have to stop.
When you talk about the rapidity today versus during the crash in 1929, you see all these pictures of people lined up around the banks, like over a period of weeks, everyone kept withdrawing funds until they ran out of money. And, as we said in the intro, like 42 billion was wired out in one day. Like that is not just a bank run. That is a sprint. It's a cyber sprint. Like it's like almost instantaneous. So I think your point is really, really important there. It's not like it happens slowly and then all at once. It happens like slowly and then, like you said, instantaneously. I think that's I guess you said it the perfect way there.
So, relative to what I think would be interesting to your listeners would be sort of the practitioner's perspective. So if we acknowledge that we're in a tightening in the credit cycle, how should we approach life and how should we mitigate the risk of being one of the people that don't get out of the theater in another replay of a similar situation?
Well, I think you're right there. I think that is a good part of the discussion. The idea is like if the insurer always shows up, there's not much to worry about, right? There's no moral hazard, there's no financial risk. But what happens when that isn't the case? And some of these rescues have been the central banks, like in the Fed or in Switzerland. They're stepping in. There's been some other examples in the U.S. where some of the trillion-dollar banks, the largest banks, have stepped in and redeposited money that fled other banks into theirs. They come and redeposit it in an uninsured way in those other banks, shoring them up. So as money flies out, it flies back in, and those banks are protected. And that could be, without getting into that too much, that could be some of the banks don't want to face the risk that they faced when they saved other banks in the past. They could say, okay, we take it over. We could have other exposures that we didn't want if we save a bank that's failing or we do a merger. And so this seems to be a lower risk for some of those. I don't know if you have any thoughts on that topic.
I guess I was going into the practitioner's perspective. If you wanted to revert to the macro, I think there's, some interesting signposts that say that, we effectively have turned banks into utilities in a way that is difficult to explain. The way banks make money is they get deposits in the simplest sense, and then they make investments or loans, usually in a longer dated fashion. And the classic, situation here is as deposits began to disappear, and it wasn't just in the last couple weeks, it was people actually wanting to earn more than just 0.5% on their savings account. Because the alternative, the 2-year treasury was been at 4.5%. The money market funds were tremendous beneficiaries of the outflows, as well as some of the other companies out there. I think you're familiar with one, and the other one, Promontory, in my time became IntraFi. And they have a way to diversify your bank accounts by spreading them around, not exceeding the 250,000, or even putting them into their CDARS program, which is certificate deposits. So I think there's a number of things that practitioners can do. Obviously, I'm a little biased at Treasury Go. We have a bank administration module, and literally we demoed closing a Silicon Valley bank account, and it takes about 10 to 15 minutes before you'd be able to move everything over to another outfit that seemed less risky. This end-to-end workflow process with a virtual approval process does ensure better controls and increase productivity. But, at the end of the day, it's also eliminating manually repetitive tasks and freeing up time for value-added work. So this software was originally developed when I was back at Microsoft. So I actually really believe in it in terms of what it can do.
So George, we talked about these things like, having multiple banks able to be diversified, sweeping amounts over 250,000, using IDAs like some of the ones we talked about. What else should we be thinking about in addition to this being prepared, able to move quickly, like you mentioned with Treasury Go? Yeah, anything else that we should be thinking about?
Well, the challenge, I recall in the credit crisis when we were repeatedly getting asked questions about, what the latest acronym was and whether or not we had invested in it and whether we held it. And it really turned into very obvious to me that you needed to get your data squared away. And the situation where you weren't doing it in a automated fashion, it meant that you had to go gather from PowerPoints and Excel sheets and everything that slowed you down. And ironically, in the effort of trying to get it right, you extended the duration of your response. Then people who were asking the questions from on high assumed something was wrong and would ask more questions, perpetuating the cycle. For example, since we're talking about bank account administration, the ability to know very quickly at the click of a button how many accounts you have at a particular bank, who the signers are, who the approvers are to move them, what the process is, being integrated with your email is all really making you much more agile. That is not possible in spreadsheets, which is how most people are tracking this type of information. And so once you're less agile because you don't have a good handle on your data, you end up being the one stuck in the theater is my analogy, I guess, for the call.
Yeah, this idea, your first point is like you have to see where where is my money? What accounts do I have? If a certain bank's on the radar or any counterparty, what do I have there? How would I act on it? And then being able to move quickly, making a decision and moving in a reasonable time frame. If I reduce my exposure, I still may need to act. I still may need to move this activity. And I do like your analogy on the theater side. In 2008, 2009, counterparty risk was very, very important. And in the intervening decade plus, that's kind of slid down the list a bit. It's not the top 1 or 2, 3 until about 4 weeks ago. Right? And all of a sudden it's like, whoa, that is really important. We really need to see that warning sign that we can look at. When I look at that, it's like it's always, we'll build houses on floodplains and then be surprised when the flood comes, and then we're all careful. Nobody does things, and we go back there. This continues to. There's a cycle that we go back to it. We ignore the fact that risks are still there, though they may not happen every 4 years, 8 years, 15 years. This, I think, too, is another thing, not just see where our funds are, but where our exposures are and what level of exposure exists.
So that's a great analogy. The FEMA analogy is very similar to, I think, the FDIC analogy in the Fed. Relative to banks and the banking sector. The comment on counterparty risk, I know that we really did take it seriously. We were adding not just our investments and our deposits together. So to the extent you held a, fill in the blank bank note in your investment portfolio, that was added to the deposit number. And then we'd also pull in the AR exposure, accounts receivable exposure. We called that our 360-degree report at the time. I think we have to recall that was, one of the weeks you were making your contingency plan for one of the big banks not being there. So you wanted to figure out payroll, and plan, B was like Bank of America. And so the next weekend, they were the one that wasn't going to be there. So you had to make a plan C. So I think that it was, top of mind much more than it is today. But it's also, I think it goes back to a little bit of the moral hazard question, because the expectation is that the Fed will swoop in and, to quote Draghi, do whatever it takes. And I think at some point, there's a inability to continue to extend that kind of liquidity, given the cycles we're in over time. As I said earlier, it just may be very similar to the Swiss example, where those you find a situation where they're not too big to fail, they're too big to save, and so they only extend a limited amount of a lifeline in order to, not unlike what occurred in the credit crisis with, JP Morgan taking over Washington Mutual and Bank of America with Wachovia.
Yeah, and GM. I mean, just the rescue, the saves. They look very different. Like you said, the moral hazard can be, oh, okay, there was no moral hazard, right? Or apparently very little at times, and then in other cases, it's okay. You've lost money, or you've lost access to it for a certain period of time.
Absolutely. I mean, it really, I think what we're trying to highlight here is that you got to read the fine print on your insurance policy, because you just might not be covered in a certain eventuality.
You might not be covered. I think we need to assume, corporate treasurers have to assume they won't be covered. And so you have to set up things ahead of time. You have to be prepared. And you have to have the tools in place. Anything else is not responsible. I think that's what we have to say, across the board, being prepared, ready, and able to act.
Yeah. So I think that, organized data and diversified accounts, and as you said, not relying on incremental help in your insurance policy.
George, great points. Thanks for joining me on the podcast. And for those who are listening, if you want to get in touch with George, he's at george@treasurygo.com. You'll see that in the show notes. George, thanks a lot.
Thanks for having me, Craig. It's great.
You've reached the end of another episode of the Treasury Update podcast. Be sure to follow Strategic Treasurer on LinkedIn. Just search for Strategic Treasurer. This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.